90% of experienced traders continue losing money because they confuse risk management with simple position sizing, ignoring that true control lies in reading momentum anticipation before the breakout even confirms. When volume explodes to 15,000 contracts and the spread widens to 3 ticks, they feel their heart rate spike and breathing shorten, but it's already too late to adjust strategy. The market reacts with violent gaps of 8 to 12 points against their position, while the trader watches their account melt with eyes fixed on the screen, shoulders tight and jaw clenched from the pressure of holding a trade that should have been cut long ago. Jesse Livermore discovered over 100 years ago that the problem wasn't in the entry or exit, but in the ability to identify when the market was ready to move against entire crowds of inexperienced operators. Most modern traders repeat the same mistakes Livermore observed on New York trading floors, focusing only on chart patterns while completely ignoring the distribution and accumulation signals that precede all major reversals. Livermore's secret technique consisted of reading tape action 3 candles before official technical confirmation, observing microscopic divergences between price and volume that revealed the true intention of big players. He developed a 3-filter system that worked in both day trade and swing trade scenarios where entry timing depended more on the market's emotional temperature than any traditional technical indicator. When all signals aligned, Livermore increased position sizing progressively, transforming what others saw as risk into consistent statistical advantage. This video will reveal exactly how to apply Livermore's complete methodology in modern electronic markets, including the 3 specific signals he used to identify reversals 5 to 10 candles in advance. You'll discover why this approach continues being suppressed by major funds and how independent traders can use this information to operate with risk versus reward ratios of 1 to 4 consistently. Subscribe now to receive rules that can change your results in advanced risk management and access technical content that simply isn't disclosed anywhere else in the trading community. Stay until the end to discover the definitive checklist that separates amateur traders from professionals and how to implement Livermore's rule number 1 in your operations today. The vast majority of traders commit the same fundamental error. They confuse risk management with simple position calculation based on a fixed account percentage. They set 2% risk per trade and believe they're protected, when in reality they're completely exposed to the true market danger. Real risk isn't in position size but in the inability to anticipate when the market is about to move against you. Position sizing is just basic math. Anticipatory momentum control is operational art that separates amateurs from professionals. When you see volume explode from 3,000 to 15,000 contracts in seconds while the spread widens from 1 to 3 ticks, the market is telegraphing a trap. The mass of inexperienced traders interprets this volume as strength confirmation, when in reality big players are distributing positions to anxious retail. Observe how price hesitates even with growing volume, forming double or triple tops at obvious resistance levels. This divergence between increasing volume and stagnant price is the first signal that institutions are using retail liquidity to exit large positions. Your body reveals when you've lost operational control even before your account shows losses. Accelerated breathing, shoulder tension, locked jaw and visual fixation on the screen are physical signs that you're operating based on hope, not strategy. When you feel your heart racing during a trade, stop immediately and reassess the situation. The market isn't going anywhere, but your ability to make rational decisions disappears when your nervous system takes control. Professional traders monitor these bodily reactions as primary indicators of emotional risk. Chart patterns only work when you can distinguish between genuine formations and institutional manipulation. An ascending triangle might look bullish on the surface, but if there's no real accumulation happening behind the scenes, you're seeing only visual noise. Large funds purposely create false patterns to attract retail to the wrong side of the move, without understanding the distribution and accumulation flows that precede all major movements. You're operating based on colorful drawings, not market reality. Violent gaps of 8 to 12 points don't happen by chance. They're the result of accumulated pressure that experienced traders can detect 3 to 5 candles before the explosion. Watch how price repeatedly tests the same level without convincingly breaking through, while volume progressively decreases. This combination of multiple tests with decreasing volume signals there are no genuine buyers above that level. When selling pressure finally manifests, the gap is inevitable because no real support exists below. The key is identifying these structural weakness points before they become obvious to the entire market. Tape action is the secret language the market speaks through micro movements imperceptible to common traders. We're not talking about conventional volume reading or traditional candlestick analysis, but rather the ability to detect institutional intention through microscopic patterns that precede significant moves. When big players start building or dismantling positions, they leave digital footprints in the order flow that can be identified 3 candles before obvious technical confirmation. This skill transforms you from reactive spectator to anticipatory participant in the market's most profitable movements. The first microscopic divergence happens when price makes a new high but volume per tick decreases compared to the previous move. Count how many contracts were traded to move price 1 tick up during current top formation versus the previous top. If it needs more contracts to produce the same price movement, buying power is exhausting even though the chart looks bullish. This analysis works on any time frame from 1-minute charts for scalping to 15-minute charts for swing trading. The secret lies in comparing volume efficiency between similar moves, not just observing absolute volume. Big players reveal their intentions through execution timing within each candle. When institutions want to accumulate positions, they preferentially buy in the first thirds of down candles, avoiding creating visible price pressure. If you observe that most volume is happening during price drops, but these drops are quickly absorbed, discrete accumulation is taking place. Conversely, when institutions distribute, they sell in the final thirds of up candles, allowing price to rise first before draining liquidity. This temporal signature is impossible to fake because it reflects real operational strategy, not chart manipulation. Genuine movement possesses specific characteristics that differ completely from institutional manipulation. In genuine moves, volume grows progressively as price advances, creating support at each conquered level. Bid and offer remain balanced, with normal spreads and consistent depth on both sides of the order book. Manipulation, on the other hand, creates obvious imbalances, artificially widened spreads, phantom offers that disappear when price approaches, and volume concentrated in few ticks without real support. When you identify manipulation, the strategy is simple: trade against the apparent direction and wait for the return to market reality. Market emotional temperature can be measured through participants' reaction speed to price movements. In cold markets, significant moves are gradually absorbed with little subsequent volatility. Hot markets react instantly to any change, creating exaggerated movements followed by quick corrections. Ideal entry timing is during temperature transitions, when cold market starts heating up or when overheated market shows exhaustion signs. Identify these transitions by observing how the market responds to news or technical moves. The change in reaction intensity will telegraph opportunities before they become obvious. For practical application across different time frames, adjust your reading sensitivity according to operational speed. In scalping, observe tick-by-tick divergences and react to temperature changes in seconds. Day trading allows more contemplative analysis, focusing on patterns that develop over 5 to 15 minutes. Swing trading requires even greater perspective, identifying institutional intention changes that may take hours to fully materialize. The technique remains the same, but patience and observational time scale must adjust to your preferred operational style. Livermore's filter system works as a validation protocol that eliminates 90% of losing trades before you even enter the market. Each filter has specific and non-negotiable criteria. If any one fails, the trade is immediately discarded, without exceptions or emotional justifications. The discipline of consistently applying all 3 filters separates traders who operate with statistical edge from those who gamble on hopes. This isn't an automatic signal system, but rather a validation methodology that refines your ability to identify only opportunities with highest success probability. The beauty lies in simplicity: 3 objective questions that determine whether it's worth risking your capital. The first filter examines whether volume is growing progressively and sustainably in the direction of the intended movement. Progressive volume means each wave of movement in the desired direction has more volume than the previous one, creating participation escalation that confirms genuine interest. Measure volume in 5 candle blocks and compare with the previous 5 candles. There must be minimum 20% growth to validate the filter. If volume is decreasing or remaining stagnant, even though price continues rising, there's divergence that invalidates the operation. False or manipulated volume is easily identified by isolated spikes without support. while genuine volume creates organic growth pattern that sustains over prolonged periods. The second filter verifies momentum alignment across at least 3 different time frames, ensuring you're not trading against the market's main tide. Choose 3 time frames in a 1:5 ratio. If operating on 5-minute chart, check 15 minutes and 1 hour. If operating on 15 minutes, confirm on 1 hour and 4 hours. Momentum must be aligned across all 3 time frames, not just neutral, but clearly directional to the same side. Indicators like MACD or RSI can help, but most important is the direction of price pivots in each time frame. If the larger time frame is making descending tops while you want to buy on the smaller one, the filter automatically fails. The third filter is the most subtle, identifying absence of hidden institutional resistance that can sabotage your trade at the least expected moment. Institutional resistance appears as levels where large volumes were traded in recent past, creating zones where big players may have interest in protecting positions. Examine the chart from the last 20 days and mark all points where there was abnormal volume above daily average. These points become magnetic attractors that draw price, functioning as invisible support or resistance. If your target is near one of these zones, reduce expectations or adjust strategy, because reaction probability at these levels is extremely high. The combination of 3 filters creates a robust validation system that works regardless of your operational style or preferred instruments. Before any entry, go through the checklist: progressive volume confirmed, multi-time frame momentum aligned, absence of institutional resistance in the path. Only when all 3 filters pass simultaneously do you have permission to consider the operation. This process may seem rigid initially, but eliminates the vast majority of impulsive trades that destroy accounts. The discipline of rejecting trades that don't meet all criteria is more valuable than any specific entry technique. Operations that don't pass all 3 filters must be discarded without hesitation or justification attempts. The market offers opportunities constantly, there's no need to force trades in suboptimal conditions. Keep a simple spreadsheet recording how many operations were rejected by each filter throughout the month.